If you are the business owner, the last thing you want is a letter from the IRS saying you're being audited. But did you know that there's specific red flags that can trigger an audit? I'm Ella Rivkin, an expert in financial freedom and business growth, and for over 26 years, I have helped countless entrepreneurs staying compliant while maximizing their profits. Today, I will break down 7 common mistakes that can put you on the IRS radar, and of course, how to avoid them. Let's dive in, and trust me, you don't want to ignore number 7. Want to avoid the IRS knocking on your door? If you're a business owner or a high income earner, you need to know the 7 red flags that can trigger an IRS audit. Alright, so let's dive in. The first red flag is the reporting too many losses for the multiple years. You have a business and you continuously report losses year after year. The IRS might start questioning whether it's actually business or just a hobby. And I see this very often when I file tax returns helping business owners, entrepreneurs, freelancers, filing this tax return showing the losses from year to year. But the way IRS looks at it, and according to the IRS rules, a business should show a profit at least for the 3 years. Look at it this way, and this is what I typically tell my clients, and then especially me being as a business owner and not just one business but multiple businesses. If you have a business that is not profitable for 3 years, you're not gonna stay in the business, right? You're gonna actually think of the ways, okay, it's whether I'm gonna close the business or I'm gonna rethink and come up with a different strategy. And in a way, this is kind of how the IRS looks at it. So if you are showing the losses on your tax return for over 3 years, then the IRS looks at this transaction as very suspicious, and this is typically what triggers the red flags and triggers the audit. So what is the solution? The solution is keep very clear records of your expenses and your income. And if you are investing very heavily in the growth of the business, then you need to document every strategy to justify temporary losses. If you do have the business, then you need to have a separate bank account. I see a lot of the business owners, what they do is they commingle the funds, they have everything all together with the personal and business. So you don't want to do this, because if you do unfortunately get triggered by the audits, then you want to make sure that in this business account you have a very, very clear records and all the expenses can be justified as business expenses. The second trigger that typically flags the IRS audit is the high deductions compared to income. And then especially in this case, I'm going to be focusing on the deductions on Schedule A, known as the itemized deductions. It's the deductions that you take for the mortgage interest that you're paying and the real estate taxes and donations. So claiming excessive deductions compared to your income is a major red flag for the IRS, and especially when filing Schedule A itemized deduction. So let me give you an example. I just had a client a couple of days ago that came to me doing his tax return with different account, and then the first thing I see this right away, and this is what the triggers the audits. This is like the major red flag for the IRS. This specific client, his adjusted gross income, AGI, was $50,000. But then he was deducting a total of $60,000 in mortgage interest and real estate tax expenses. So now here's what the IRS wants to know. How did you purchase a house with that income? Your income is very low. How are you paying your mortgage every single month if your income equal actually even less than the total mortgage deductions together with the real estate tax? And then the next question is then, are you reporting all your income correctly? Because obviously, if you're paying all these expenses, then there is some kind of a source of income. I mean, they don't know all the other things that going on in your life. So obviously for them, it's right away the red flags. And that means that there's some kind of extra income that you're not reporting correctly. So why is this a problem? So here's the thing. The IRS knows that unless you have unreported income, it's impossible to sustain a lifestyle that costs more than what you're actually making. If your itemizing deductions exceeds your reporting income, then you are waving a big red flag for an audit. In addition to that, what I also wanted to add is that the IRS sees everything. IRS sees how much you purchased the house for, how much you are giving the down payment. Here's another thing, if you're making prepayments, IRS sees this as well. And then at the end of the year, when you receive the form 1098 that reports the outstanding year-end balance with the total interest you paid for the year to the bank, with the real estate tax you paid, if you have like coins that you paid, if you did prepayments, everything is reported on that form 1098. Everything that gets this reported on 1098, so the bank sends this to IRS as well as they send it to you. In fact, last week I had a client that came to me also from a different accountant, and then when I look at his 1098 form, the first thing that I see is that he made like about 100,000 in just one single year in prepayments towards the mortgage. The IRS sees all of that, and then if the income is less than what you total prepaid in a year, plus the total interest payments, plus the real estate tax, plus the insurance, then obviously the next question, where is that income? Then that means that you have unreported income, which you're not reporting. All right, so here's the solution. Number one, ensure your income and deductions are aligned realistically. Because a lot of the times, and I see the clients, they're thinking that the more deductions we have, the better it is, but that would not be the case. The second one is keep detailed records and documentations of all the deductions. And the third one is the most important one, that hire a tax strategist, not just the person who is going to do your tax return, not just a tax preparer. Because typically if you're hiring tax preparer, they just take all this paperwork that you receive from the IRS, then just plug the numbers into the system, into the software, and then they just generate your tax return. You actually do not want to do that. You want to make sure that you have a tax strategist who actually understands your whole situation in depth, and then based on that whole situation, they create a customized plan that allows you to legally maximize deduction, lower taxable income, and avoid IRS red flags. The third red flag that triggers the audit is misclassifying workers as independent contractors. So if you have workers in your company, but you're classifying them as independent contractors, or you're paying them cash instead of actually treating them as an employees, then the IRS might investigate you. So why would they do this? Because independent contractors, they're not required to pay payroll taxes. And obviously, IRS wants you to pay taxes. This is like an extra income that they're receiving from the business owners. And then if they're not your employees, then they're not going to be able to charge this money. Here's another thing that I wanted to bring up to your attention. So actually, it's not just the IRS that is looking at the independent contractors. So since IRS doesn't have so much of the resources, and we're talking about that there's over 30 million businesses in US, then what are they doing is that they're reinforcing this through the state, through the city, through the insurance companies as well. There's a number of different ways how this audit can be triggered. One of the ways with Department of Labor. So Department of Labor periodically, randomly, they can audit your company. They can come and review all your books and records, do an audit and see if you're paying all your employees legally on W-2. Once they do the audit and if they find something, and if they find that you misclassified your employees, you misclassified your independent contractors, in fact they are employees, if they see there's a lot of them, what they can do, they can actually report this to the IRS, and that would trigger an audit. And the IRS in this case would come and then they would audit the company. Another way it can trigger an audit is, let's say, if that employee gets injured. Okay, so if you have a driver, he got into the car accident, or if you have like in the construction, and I have like all these different cases that I see. Someone cut the finger, someone fell out of the roof. So there's different type of things that happening. So when this type of things happening, then the next thing is that employee, they get injured, they go to the hospital. Now they need to heal themselves, they need to recover, and then the next thing is that what happens is that they start suing the employer to collect the benefits for the loss of work as well as for the damages. The next thing what happens is that the insurance comes in and says, okay, we have the claim, but that person was never an employee, is actually an independent contractor, or maybe he is even paid off the books. The solution is use the IRS guidelines to properly classify your workers. And if you're in doubt, or if you don't know if you're doing the right things or not, or if you're trying to be creative, especially actually creative paying them cash, thinking that since you're giving them cash, then no one is gonna know about it. I don't think this is a great time to be creative. So what I would suggest is to consult a tax professional, have a right advisory team who can actually guide you in the right direction to avoid these triggers. The fourth red flag that triggers the IRS audits, it's too many cash transactions. And in this particular case, I'm talking about money coming in. It's whatever you're earning and whatever you're spending. So let me break this down for you. So the first one is whatever you're earning. If you're the business owner, sole proprietor individual, self-employed individual receiving a 1099, or if you're the freelancer, and there's many businesses like that today, then mostly of you dealing with the cash, and IRS might suspect unreported income. So many of you probably thinking, okay, if I'm receiving cash, or if someone just gave me a check and then I cashed it out, then no one knows about it. How is IRS gonna know about it? Then why would I even report this income? Why would I even report this money? But here's what actually happens. Well, first of all, you might not be reporting this money, but then yet still you're paying for all of your expenses. And then when you're filing the tax return, going back to the first trigger, is that your income is very low comparing to all the expenses, all the deductions that you're having. Another thing, okay, you're receiving all this cash, you're saving all this money, you're not reporting them, and then at some point you want to make a large purchase, you want to buy a house, okay, and then you need to now legalize this money, and by doing that you're trying to put them back into the bank. Now we're gonna go into the second one, is that all the transactions over $10,000 in cash, if you put in cash into the bank, then they get to be reported to the IRS by the bank itself. So if you're not reporting all this money that you earn, you're collecting them, accumulating them, and then you start bringing them to the bank, then the bank sees all of that and they are required to report this to the IRS. Okay, so now the same thing works in reverse. Now we're talking about if you're taking the money out of the bank as well. So if you're taking large transactions over $10,000 in cash, then the bank reports this to IRS as well, and then that triggers an audit. You might be buying a car with the cash, and then you just go to the bank and you take all the money out. I mean, instead of probably doing that, the best idea would be maybe to write the check. Or if you're business owners and you're paying someone cash, you're paying your employees because you're trying to misclassify them, not to show them as your employees, not to pay the payroll taxes. So what you're doing now, you're taking this cash out of the bank. The bank actually reports all of this to the IRS. And here's another thing that I wanted to point this out. I see very often many, what they do is, okay, they would take $8,000 or $10,000 thinking, okay, you know what, it's under $10,000, the bank is not going to report this to the IRS. While yes, it's true, they will not report this particular cash withdrawal to the IRS. However, the bank monitors all your transactions that you do on a daily basis, weekly basis, and monthly basis. In fact, they actually have a whole investigation department, especially just to monitor this type of transaction. So let's say if you took 8,000 today, and then 3-4 days later you went to the bank and took another 8,000 and then another 9,000, and let's say in a month altogether you took like $50,000-$60,000. So guess what's gonna happen? The bank is gonna report all of this to the IRS, and this might trigger an audit. So here's the solution. For those of you that are receiving cash payments as the deposits, make sure that you keep clear records of all cash transactions and you report large cash payments correctly. Make sure that you have a separate bank account, so it doesn't matter if you have your business, if you're just starting a business, if you're a freelancer, if you're a self-employed individual. You want to make sure that you have a separate bank account where you keep records for all this money that you're earning and coming from these transactions. And those of you that absolutely necessary need to make a cash payment, make a large cash withdrawal transaction, before you do this, find a different ways. Today it's very easy. You can just write a check, or you can just do a bank check, certified check, cashier's checks, and that will be equal to the cash payment. But then obviously I wouldn't even know why would they want to cash from you, but typically they just want to make sure that you do have the money and the money is going to be cleared. Then you can do a cashier's check or bank check and avoid taking the cash out of the bank. The fifth red flag that typically triggers IRS audits, it's claiming 100% business use for a vehicle. If you deduct all vehicle expenses as a business related, but do not have another car for a personal use, the IRS may question this. In this particular case, I like to point out a few things. Well, the first one is if you have the vehicle and you don't have any other vehicles, and then what you're doing is that you're putting the whole cost of that just one vehicle and you deducting as a whole business expense. So then in that case, obviously it may trigger the red flags and IRS might audit you, because I mean, every time whenever someone is asking me if I can deduct this fully, I would always say, okay, everything has to make sense. It has to be reasonable. Okay, if you have a family of 4 people, or if it's just you or your spouse, or even if you, and then you're showing that you're using this whole vehicle, this car fully 100% for the business, it wouldn't kind of make sense, because obviously you do need to commute, you do have your personal stuff that you're doing, so that might trigger an audit. Another thing that I wanted to point out, but I think the second one is the biggest one, even comparing to the first one, it's the cost of these vehicles. A lot of clients, and I even hear lots of accountants suggest this towards the end of the year, when business owners have cash on the bank account, they have profits and lots of money. Another thing, one of the most common things that they suggest is purchase the vehicle. I see these business owners, they buy these vehicles, like high expensive cars, and then to take the full deduction. So here's the problem that I have with that. Everything has to make sense. What do I mean by that? If I see the client, I see the business owner that is making $20,000 in his business, and then yet he is driving a G-Wagon that costs like over $100,000, and then taking a deduction for that. If you are a consultant that sits at home and takes phone calls and consults your clients without actually even driving that much, that wouldn't classify it that much as the business expense. And another thing is that why do you need to have even such an expensive car if you are solely working just from home? So here's the solution. Maintain a mileage log. If you are deducting your vehicle based on the mileage, make sure that you're showing the exact business and personal trips, and then you don't commingle them, that you can separate them. There's different apps that you can use to track your miles automatically. Do not think that there is a one size fits all. If your friend or someone told you that they purchased a car over 6,000 pounds at the end of the year, and then they deducted the whole 100% of it, and then they got this massive tax deduction, it means that this will apply to you, because I do see this very often. But in this case, what I would actually suggest is that, listen, it might be the case for him, and I'm not opposing this, but is this the right case for you? So in order to identify this, it's to hire a right tax strategist, tax professionals, advisors who can actually find out the exact situation, your business and personal situation, and then see how to take the most of the advantages of all these tax deductions, so you can not trigger these red flags and have the IRS audits. Do not think that you are the smartest ones and then they have no idea what they're doing and what's happening. They know all of this, and the last thing that you want is the IRS knocking on your door. The sixth red flag that triggers IRS audit, it's rounding numbers too perfectly. If your tax return is full of perfectly rounded numbers like 5,000, 6,000, 10,000, that is very suspicious. And for those of you who are listening to this, you're probably thinking, okay, who would do this? But believe it or not, I see this very, very often. Some that prepare their tax return themselves, or some that using those professionals that maybe they're just starting out, or just doing this tax returns preparation at home. I see very often they're just literally rounding their numbers. Again, I don't know what's the reason behind that, but it's the fact. I see this, and this is something that will obviously trigger the audit. If this is a real business, there's no way you would have real numbers. Then you actually would add up everything, you'll have the cents, the different numbers, so there is no way it would be the round numbers. The bottom line is that if you are a business owner then obviously you wouldn't have the round numbers, and the IRS expects the real expenses to be uneven. Like let's say $4,978.42. You're not gonna round it up and say $5,000. So the solution is reporting exact figures from the receipts and invoices, not estimates. Do not estimate. Just add up. If you're doing your tax returns yourself, then add up all the receipts and all the invoices and write down the exact numbers that you have calculated. And the last one is the most important one. The 7th red flag that triggers the IRS audit is filing a Schedule C. So if you're a single member LLC, filing a Schedule C. If you're a sole proprietor or freelancer and you're filing the Schedule C, this is one of the most highly audited tax return by the IRS. So now you're probably asking, why is that? Well, because unlike W-2 income, where you receive your income, the IRS takes right away all the taxes, and there's absolutely nothing else that you can do. You cannot deduct anything, you cannot reduce your income, there's nothing you can do. With the Schedule C, with the freelancers, LLC, sole proprietors, it's then you report your income on the Schedule C, on your personal income tax return. And then by reporting this income, you have availability to take advantage of all the deductions that are business associated. So then the IRS doesn't actually know if all the deductions that you're reporting are actually business deduction. They do not know if the deductions are the accurate deductions. So then this is why this is a very highly audited tax return by the IRS. If you underreported your income, they will come looking for you. If you claim too many deductions, they will ask you questions. The biggest red flags: excessive deductions that do not match your income. Okay, let's say your business earns $50,000 per year, and now you're claiming that you have like $45,000 in travel expenses. Or as I already mentioned, if you're claiming that you have $45,000 in vehicle expenses, that you purchased the vehicle, and now you're deducting this whole $45,000, but then your business not even in a transportation business. So obviously it all goes back that it has to make sense, it all has to be realistic, and all the expenses that you have, they are actually aligned with your business and they are in proportion. So another thing actually that I wanted also to point out to you, it's to pay attention what other types of income do you have. So what do I mean by that? So let's say in this particular case you are a freelancer, right? And then as we already gave an example, let's say you have $50,000 that you earned as a freelancer, but then you don't have any other source of income anymore. Let's say you have a wife and you have 2 kids, and then there's a family of 4. You earned $50,000 a year, and then it might seem like it's might be normal amount of income for a family of 4. But then on the other hand, you're showing all this $45,000 in expenses, even though they might be real expenses, not just like a travel or transportation, but they are like all real expenses where you have like a telephone, computer, office expenses, maybe even a salary, right? And then you're deducting all these expenses. This is all great. But here's what the IRS is looking at. They're not looking at the $50,000 that you earned. They're looking at the bottom line. So you earned $50,000, you had $45,000 in different expenses. So the net income was $5,000 after all the expenses. So now if you have $5,000 and you have a family of 4 people, even if you don't have a house or you're only renting out, then the next question is, how do you actually live? How can you support your lifestyle, support your family, just only earning this $5,000? So that will trigger an audit. I see this very often, like these freelancers, business owners, self-employed individuals, they come, we have like all these deductions, we have like so many expenses, and then we didn't earn anything. But then if you didn't earn anything, then like how are you living? How are you paying for food? How are you taking care of your children? This type of red flags, this type of situation typically trigger the audits. So what is the solution? Always keep receipts, have a separate bank accounts, maintain a detailed records, and ensure every deduction is strictly business-related deduction. And a better solution is if you are single member LLC or you're freelancer, you sole proprietorship, or you're just starting a business, is convert your LLC to an S Corp or to C Corp. This way, by doing that, you will actually deduct more expenses legally, reduce self-employment taxes legally, and lower your audit risk. If you are still filing as a Schedule C, it's time to rethink your tax strategy and book an express audit with me. In conclusion, if you want to stay off the IRS radar, I would suggest you to follow all the tips that I shared with you in this video and always keep detailed records. But if you're looking for the creativity, do not try to do it yourself. And if you're trying to get creative with your taxes, then don't do this alone. Navigating business taxes requires strategy, not a guesswork. A strategic tax planner can help you legally maximize deduction, minimize liability, and keep you out of the audit. I have helped thousands of business owners uncover hundreds of thousands of dollars in tax savings while staying fully compliant. So let's connect and create a strategy that works just for you. Drop a comment if you found this helpful, and don't forget to like and subscribe and hit the bell so you never miss a money savings tip.